Before I start reanalyzing for my week ahead, I always go through the previous week and see how I should have capitalized on this specific week, because once again, the market creates patterns that happens over and over again. So I'm going to go through all the pairs, where we would have entered, how we could have entered, where our stop loss would have been, and obviously how we would have made the most out of the past trading week. Okay, so I'm just cleaning up the chart so it's a little bit easier, so we can see there was Monday morning. So we knew we were looking for a pullback. Okay, so I prefer trading with the trend, but obviously some weeks we're going to have to capitalize on the pullback. So knowing that, we knew that price should be pulling back most probably into the range of 61 to 78% FIB. So all we had to do now is see how we could capitalize on that move to take the market into that level, and then from there obviously look to continue to the top side. So let's drop down time frames and let's see how we could have capitalized. Okay. Going into the week, we have usually a few indications telling us. So we had that weekly high that we already discussed over there as well. Price was supposed to go and take out that level. Okay. Price failing to take out that level is usually our first indication, and that is obviously where price forms a little bit of a lower high. So now we have the daily spinning tops. We have a nice indication of a lower high, and all we waited for is a little bit of a momentum shift. So that's usually where I just add in my normal analysis like I would, and I look for a little bit of a continuation levels. Continuation levels, once again, is a resistance forming to create another lower high, and then from there see how we could execute based on that specific level. So going into the week, we had quite a nice area of demand over there as well. So the better trade will be to wait for price to break through that level. That will be a lower high, a lower low, and then we know we have a lower high, lower low, and then we're executing on that lower high on the retest on that specific key level. But obviously we're not going to wait the whole week. As we are traders, we are obviously eager to get back into the market. So price then formed this resistance over there. So we saw a lot of selling pressure in that specific range, and if you add your FIB from your low to your high, you can see 61% FIB is just a little bit higher than that. And that will act as an area of resistance and also an area of supply. So 0.1, 0.2, 0.3, 0.3 is your key indication of where price should be selling off. So you could have either executed the trade over there or over there and try and run it into that specific level. If you're taking a trade somewhere in that specific range, you already know that stop loss should be above your 61% FIB, because that is our area of supply that we currently have. And then for me, realistically, I will be targeting these lows, as obviously you can't say that price is going to form a new low, as we are still in a buying trend. So once price closes below that area of supply, immediately you're looking to the left hand side and see where is market selling from, and then from there you're looking to get your new area of supply. So once again, multiple ways to do it. For me, simple, just add your FIB from low to high. 78% FIB is just above that specific area. So price just dipped into that level. So for me, this is once again a trade that I will more adapt to than anything else, because obviously price is going to push into that level, then pull back, and that just doesn't give us the right timing to actually enter a trade. So that's usually when I drop down to like the 15 minutes and I look for continuation levels. So if you look to the left hand side, there was selling pressure over there. There was selling pressure over there as well. So price then broke through that level, didn't get us a little bit of a retest there, so that level also not going to be used. And then once price reaches back and closes below that area, retesting this selling pressure, then I will look to execute a trade based on that specific level. So obviously, understanding that I'm trading lower time frames, I need to know that my stop loss is going to be a little bit smaller, but it really doesn't matter. At the end of the day, it's always about risk reward. So now that the 38% FIB, which is also the continuation FIB, lines up with that specific level, where do we put our stop loss? If you look to the left hand side, you're also going to see that spike. So that spike will determine the liquidity in that specific area, and that will be used as an area of supply. And then we know we can put a stop loss just above that area, and obviously targeting that lows to the left hand side over there. Okay, so AUD/USD has an inverse correlation to Euro/AUD. The Euro is a free-flowing pair, meaning if AUD/USD is going to have a pullback to a downside, then Euro/AUD is going to have a pullback to the top side. So pretty simple. Starting it off, we had a key weekly area over there, so indicating a lot of buying pressure in that specific level. So we can see a little bit of a liquidity grab, obviously indicating that we are breaking to the downside. But if you don't look at your correlation, you're most probably going to take the sell where you should be taking the buy just based on your correlation. So perfect spinning bottoms at that bottom, forming quite a big area of demand as it is a key weekly level over there as well. So looking into that, there's our lower high. So the better trade once again will 100% be for price to close above that area and then look for the continuation. But you don't always need to wait for that. You can obviously drop to lower time frames, low, 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 high, low, low, higher, high, high, low, retesting on the key weekly area, and you can look for execution on that specific trade. As I explained in the previous video as well, if you missed that trade or something happened that you wanted your PC, always look at where does price actually buy from. A lot of buying pressure in that specific area, indicating a continuation into that specific levels over there as well. So that's point number one. Or point number two, you can just add your fib from your low to your high, and then you can see you have your 61 and 71% fib just below that specific areas. So with euro order, it's really important to understand that the pip count is lower, meaning for every 100 pips this market moves, okay, 100 pips or 100,000 points, it only actually moves 64 points because it only has a $64 value, pip value, okay? So meaning that if we have a stop loss of, let's say, over here, 230 points or 23 pips, we're actually going to have a stop loss of like 160, meaning for every 1 cent we use, we're actually going to risk $1.6. So we might or will most probably use a little bit of a bigger lot size, because remember that you need to have the same dollar risk every time, not the same lot size risk or anything in that sense, the same dollar risk. Okay, so that was our first trading opportunity. Second trading opportunity, we could have taken that retest, or that retest and continue into the higher levels. Okay, then price finally took out all those highs of the previous highs over there as well. And once price liquidates that specific level, we know we're looking for continuation. So if you're looking for continuation, what is the continuation fib? 38% fib. There's a 38% fib lining up as well. Then we can look to the left hand side. We can see there's a lot of buying pressure in that specific range, and just through that you form your own area of demand. So for me personally, that would have been my two trades that I would have been looking at. This would not be the trade that I would have been looking at, because for me, I would have waited for a little bit of a deeper pullback into the market. Most probably be looking for pullback into that specific range. So I would most probably not capture that specific trade, as I just prefer trading from the 61 to 78% fib and a point with higher confidence. So once again, there's multiple ways to find this confidence. It's not just the things that I'm using. There is multiple ways to use it. Okay, then end of the week, once again, price took out that area of supply over there as well. Once price closes above that point of liquidity, you know you can take the continuation, but obviously at this point it is a little bit overbought and should have a little bit of a bigger pullback, because after the 38% for price tends to pull back the deeper level, which should be over there, and then take the continuation from there. Okay, then once again, looking at Euro GBP, there's a lot of things that came into factor, once again, like the lower high. So we already had the lower high indication, indicating selling pressure to the downside. What you can also do is look at that specific area. So last time price sold from that level, we moved to this specific area over there. So already you have a standpoint of, okay, well, this is exactly what we're looking to do going into this week. Price is already selling within this specific range. So we are looking to move all the way down. Monday was only there, all the way down to that specific area. So how do you then deal with it? Once again, look at where's the sellers at and how can you trade the continuation on this specific area, which obviously leads to lower time frame trading. So we can see there's selling pressure there as well to the left hand side, and that's pretty much it. So there's no other selling pressure. So the only trade we were able to take this week on this specific pair was once price closed once again below our area of demand, so all that spikes over there, we knew that the buyers have been liquidated and we're looking for continuation. If you're looking for continuation, what fib is that? It's your 38% fib. So there's a 38% fib. It's actually a little bit higher over there. 38% fib over there. You have your psychological level of 85500. So there's multiple reasons for price to sell from that specific level. So Euro GBP has a pip count of 1.2, meaning that for every 100 points the market moves, it actually moves 120 points. So if you have a 0.85, you're actually going to be risking like 0.94. for every 1 cent that you're trading. So a little bit of a smaller move on Euro GBP. You don't see the big moves. And that's once again why it's important to have the same dollar value risk. Because for example, if you take a 1 cent over there, you're only going to be making $4. But on the other trade, you're risking $4. So you need to be using like a 4 cent to make sure that you're risking the same dollar value, that your reward is the same dollar value. But that was pretty much the only trade on Euro GBP this week. We could obviously see price did come back and retest that previous lows as well. But for me, that will not be a trade that I will be taking. As once again, I am looking at the point of the most confluence. Okay, USD also we knew we're looking for pullback. Number one, big key weekly area. Number two, obviously we're looking for dollar bulls. So Euro USD 85% correlation to dollar index. If dollar index is going to go to the top side, this is going to go to the downside. 85% correlation. Okay, so on the higher time frames, we saw price forming that lower high. So for me, that's not enough because you will end up in losses a lot of times if you're trying to execute on the best trade. For me, it's always once again about the better entry. So what am I going to do? I'm going to look at previous selling pressure. If price sells from this specific area, we can see this big drop off to the downside. So once price came to the downside, we formed this area of support over there. So once we liquidated that area of support, we know that the buyers have been taken out and that we are looking for short positions. So once we started pulling back, only on Thursday I would have looked to execute a trade on this specific area. 78% fib just above that area. We also have the flag pattern coming into play as well. 0.1, 0.2, 0.3, 0.3, your highest probability touch in the market. So I would have been looking for a short position over there. Stops above that previous spikes over there. So quite a small stop loss, 126 points or 12 pips. And then still a good risk reward ratio. So I'm showing multiple ways of how to approach the trade and how you can take the trade, because at the end of the day, it's about two things. Am I using the right risk management, and do I have a good risk reward on my specific trade? So let's drop down to the lower time frames to see if there was something else that we could have done. So looking at this, price just went straight through. So you could have identified the selling pressure there to the left-hand side. But once again, price just went straight through to the take profit level and there was no pullback on that specific area. So what you also could have done is this flag pattern is there on the inside as well. 0.1, 0.2, 0.3. So you could have waited for close back above that area and take the buy. But once again, for me, it's not too valid. So will I be taking the third touch? That is what you guys will see. Of the fourth touch, that's what you guys will see on the next video coming up. GBP ORD in the same boat as Euro ORD. So if ORD is going to have a pullback to the downside, it's going to have a push to the top side. GBP ORD correlates more to the Australian dollar than it does to the pound. So if I'm looking at GBP ORD, I'm also looking at ORD USD. So the reason this had a bigger push than Euro ORD, once again, Euro GBP, we were looking for shorts. Okay, if we're looking for shorts on Euro GBP, that means that pound is going to gain strength. If we're looking for USD to go short, that means that the Australian dollar is going to lose value, which will also push this up. That's also how you find a highly active trade within the market for the week ahead. Okay, then looking at the basics, once again, we had that inverse head and shoulders. We had the third touch already on the weekly. So all we needed is a little bit of a high low to be created. Price created that high low. What do we do after the high low? Do we just execute on there? No, because we don't know if that's going to be valid. Although there's a lot of buying pressure, we should have the 61 to 78 fib coming into play there as well. For me personally, once again, I'll drop down time frames and look at continuation buying pressure. So from where does the market continue? Buying pressure there, buying pressure there. So I would have been looking for that little bit of a break of structure. Okay, so you can still use your supply. So there was a little bit of area of supply. Price liquidated that area, moved back into the specific buying levels, and then from there I would have executed a trade over there. So very simple, same rule we've been going over and over again. If you're looking for continuation, that was a trend trade, so 61 to 78% fib, like I just showed you guys. But then we're looking for continuation, and continuation happens from where? From the 38% fib over there, and perfectly just pushing into new highs. So if we go back to the higher time frames and we just clean everything off, we could also see that we are in a little bit of a sideways market. So after the sideways market is broken, price is looking to come back to retest that sideways market and obviously continue to the top side. So once we broke structure to the top side, we're obviously looking for continuation after the break of structure. So there's your 38% fib. Use that 38% fib as area of demand. And we also have the psychological level there of 250. Multiple indications, once again, that price should be continuing up. You can add a trend line there. It's just too, steep. So it will more be an area of support that we're looking at. And you can also go back and look at previous buying pressures, which was in that specific area, and that will form an area of demand. So that was the second trade that we could have capitalized on, and obviously just extended there to the top side. For me, would have had a little bit of a bigger stop loss, as I would have placed my stops below that spike. But at the end of the day, still a perfect risk reward ratio. So GBP order also low pip count, meaning that if price is going to move 2,000 points, also 0.66, it's actually going to move less. So 345 stop loss now seems like way bigger than the stop losses we've had in. But if you take a 0.66 pip value, price stop loss would actually be like 0.2. So let's say about 210 points. So for every 1 cent, we will be using 1 cent times 210 will obviously equal to about a $2 risk. So if we're risking $10, then we will obviously be taking a 5 cent on this specific position. Okay, so GBP ORD started the week off obviously with that low previous week. Then we formed this high and low as well. So there we had a low, 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 high, low, low break of structure, high, 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 low. So we already had the high, high, and the high, low in place going into the week. What do I look for? Where's the buyers at? That's always what I look for, because if we can find the buyers, we can see what we're supposed to do. Then you can add your bigger time frame fib, and this should line up with the 38% fib. So now we had quite a big confidence point. We had buying pressure, we had the 38% fib, we had a psychological level of 125. So we knew that we can drop down to the lower time frames and see how we could capitalize on that specific area. So if you drop down to that specific area, you can add your smaller time frame fib now from your low to high. Then you can see there's a 38% fib. Create yourself an area of demand, and from there see how you can execute based on that specific area. So I would have been taking long position somewhere in that range. Stops would have been below that area over there, so about a 300 point or 30 pip stop loss, indicating we're targeting at least a 60 pip return. So that would most probably be my exit point. Obviously we had a weekly low form, so that would have been my exit point, but you could have extended that as well. So let's go back to the higher time frames and let's see where the buying pressure was at going forward. So there was some buying pressure there. Let's see, price just took out all that levels, and then there was some buying pressure there to the left hand side. So that would have been another position for us to scale into on that specific area. And if we have to refine that area over there, we already knew there's buying pressure there. If you added your fib from low to high, we could see this is 61 to 78% fib, indicating an area of demand, and that is obviously where we would have executed that specific trade. So now a little bit of a smaller stop loss, but also a little bit of a smaller target on that specific trade. Okay, so USD CAD is not a pair that I favor, to say the least. We could see we're in a selling trend, low, 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 high, low, low, awaiting a low high. So that would have been the position that we're waiting for, is that actual trade over there. But obviously we know price should be pushing up to that level. So if I say price is going to pull back to that level, it doesn't mean we are not allowed to execute. That is the better trade, 100%. But it doesn't mean that we're not allowed to execute anything before that specific area. So you can still add your buying pressure over there, then drop down and find your confluence. So if price can take out X, Y, Z, then we can look to execute. So already we had a low, 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 high, low, low, or higher, low, higher, high. So there we had our area of supply. Price closed above that area of supply. If we look to the left hand side, there's a lot of buying pressure over there. And once again, you could have simply just added your fib from your previous low to high. See, there's a 61 fib lining up at that level, forming your area of demand, and you could have taken that buy position to the top side. If price bounces off that level, we have continuation from that specific area, and there we could have seen there's a nice area of demand with that spike being formed, and we could have taken another trade to that specific area. So why did we close there at the top? Because that was our target going into the week. We already knew that is a hard time from target, and then from there we should be looking to execute based on that sell position, because that's originally what we were waiting for, is for price to move into that area, then take a short position from that specific level. Okay, then the one you guys always wait for is the gold. So gold, once again on Monday morning, we had one of two things. So we had that selling pressure there to the left-hand side created before session, and we obviously had that buying pressure there as well. So we knew we were waiting for one of two things, okay? Either for price to push into that level and take a trade today, or obviously for price to dip into this level and take the bias up to that level over there. So for me, I usually have my hourly levels in, and then I usually drop down to the 15-minute and see how I could execute based on that specific trade and specific market. So there's a few things that I would have realized once again. Is number one, you can also look for selling pressure. In this case, there's no selling pressure to the left-hand side. So we knew we're only waiting for this specific area over there. So this is a case where a lot of traders could maybe be seeing something like that. This is actually exactly what happened to me. If you guys look at my live trading, I took a buy position over there and I had a 350 stop loss. So price just triggered my stop loss and I obviously lost 1%. But then price pushed straight up because it's just a little bit of a liquidity grab. I was a little bit impatient. I didn't wait for candle close or anything in that sense. I just executed a trade. Then once price closed above this area, I re-entered with the exact same parameters and I made about a 34% return on this specific trade. So risking the same amount, doing the exact same thing, but obviously just adjusting and understanding that nothing went against me. I just executed a trade a little bit early. Then going into, just take out all those levels. So going into the next day, we had that low formed over there. We had that high formed over there. So we knew we're looking for dip into this area or obviously a push into that specific area for the short position. In this specific instance, we're obviously looking for that trade over there, 350 stop loss. And then once price reaches 350, it's a really strict rule. The reason I have this rule in place is because I've seen how many times it goes against me after 350 points. So 35 pips. So once we reach 35 pips, I'll move stop loss to break even. And this would have been a little bit of a break even trade. So this is where the interesting part comes in. If price moves in and we're still in the range, don't be afraid to go into previous levels. So into previous setting levels and see if there might still be an opportunity to the left-hand side as well. So if we took this trade, once again, went straight to the downside from that specific area, and then we would have had another break even. So about 2 break even trades for that specific day. And then obviously after the session only, price had the initial move that we were waiting for. Okay. Then looking at Wednesday, we had one of two things. We had that area over there and we had that selling pressure over there as well. So going into the session, straight off the bat, we are retesting that high over there, just about 12.15. So a little bit of a quick trade that we have to execute over there, and then just a perfect move to the top side. And so what will happen a lot of times is you will miss that specific move over there, and then you'll try and see how you can execute on the buy position. But we went straight through, took out that area of demand over there. And if demand is obviously taken out, we know we're looking for continuation from that specific level and then to run it to a downside. So that would have been our position on Thursday. Then Friday, once again, a few things that happened. There was our previous high and there was our previous low over there. So price immediately pushed into our selling level over there as well. Then we obviously would be looking for that specific trade, 350 stop loss. It's just a general rule, so you can still use the previous techniques that I said. So there's a 78% fib, so I know 350 is fine as long as we are below the 78% fib. We are good to go. Price dipped into that selling area over there. We have broken structure to the downside, so multiple indications, and then from there just a simple short position that you could have extended. And it's really important to try and capitalize on these bigger moves, because if you're not capitalizing on these bigger moves, it really gets to a point where you're losing 1% to make 1% the whole time. So a minimum of 1 to 2.2 risk reward ratio. 1.3 is obviously perfect, and there is days where you can just extend your TP and make that 1 to 9, meaning that you need to lose the next 10 trades, for example, to go into a loss. Okay. And then finally Friday we formed this lows over there. We formed that highs over there as well. So could have been a little bit of a quick buy position. Could also have been a little bit of a quick sell position there as well. But say the least, it would not have been a good trading session because you would have taken that short position. If you took a 1 to 2, would have gotten out of the market, would have been perfect. On the buy, 1 to 2. On the sell, 1 to 2. But obviously getting towards the close, the close of the session, we would have hit a stop loss and then price would have actually gone away. So if you take that trade once again, so let's say you missed the buy, you missed the sell, and you end up taking that trade and it hits your stop loss, once again, close out. Don't try and now execute on the buy position outside the session. Just take your loss. You're going to take losses. It's part of the game. It's part of the industry. And once again, if you do take that buy, stick to your rules. Once price reaches 350, which it perfectly did, then from there you need to understand that, okay, perfect, stop loss to break even. So you would have had a break even trade and still not a loss. So the 350 that I calculate, just the last thing, is usually from perfect entry standpoint. So if I have a perfect entry, I'm going to have a 350 stop loss, meaning that if I'm going to enter somewhere there, I am going to have a bigger stop loss. So I'm adapting because I'm working out the 350 from the ideal entry point. Thanks for everyone that is watching and supporting. I hope to see you guys on the next one.